guys, I'm Rose. Welcome to the Money School. This week, I want to talk a little bit about my strategy for long-term investing. One common strategy is peso cost averaging. This method is a type of investing wherein you just keep buying a fixed amount at regular intervals, regardless of the market price. This method is recommended by many financial advisors as a good way of investing for long-term goals such as retirement. If you are in your 20s or 30s and have a long time frame, they say that investing regularly in equities will give you the best returns. It is widely believed that the risk premium for investing in equities will give you greater reward. Because you are investing in stocks, which is considered a high-risk paper asset, your gains are predicted to be greater. However, consider also that the wild swings of equities go both ways, up and down, boom and bust. In fact, a chart made by Thomson Reuters comparing the performance of global financial assets from 1996 to 2016 showed that bonds beat equities overall in that period. But one important thing to note, and it's quite apparent in the chart, is that definitely if you keep your money in cash or regular savings accounts, you will lose over the long run. Stocks and bonds rose over 200%, whereas cash rose just over 50% in the 20-year period. Due to possible copyright infringement issues, I won't post the chart here, but you can reach out to me if you want to see the chart I'm referring to. So, what's a savvy investor to do? Do you know the saying, time in the market over timing the market? It means that it's very difficult to time the market, and that it's more important to start investing early and invest for a long period of time rather than try to enter at a good time and end up delaying entering. Well, I don't entirely agree with that saying, and so I don't entirely adopt peso cost averaging. While staying invested for a long time in the market is important, when investing, it's also important to reduce exposure to an overvalued market and add exposure when prices are down. In other words, I agree with investing regularly, but I don't believe in automatically buying regardless of whether the market is up or down. The amount I set aside for investing is regular and consistent, but when I decide to buy will depend on current market levels. It's like going shopping. Do you blindly buy items without checking the prices? If you do this 1 or 2 times, it won't hurt. But do this regularly over many years and you will definitely lose a lot of money. Just like when you go shopping, you need to be on the lookout for times when the market is on sale. You want to be able to buy more when prices are at a discount, right? When prices are going up and down over the short term, from a long-term investor's perspective, the periods when prices are down are like flash sales. There is opportunity in volatility. So this is how I invest our money. First, I have a set regular amount for investing. I computed that is the amount that we need to set aside to retire comfortably based on our financial goals. Link to my episode on setting financial goals is in the description. So, as soon as we get income, I park this investment amount in a high-interest savings account. I have buy levels, which means prices at which I would want to enter for each of our investments. I monitor the market, and when prices are at my buy levels, that's when I invest. If the market prices are higher, I reduce my investment amount. If prices are even lower than my buy levels, that's when I will add even more to my investment. This way, I am able to bring our average investment price lower than if I had just invested at regular intervals while disregarding market price. This is what they call buying the dip, or more specifically, averaging down, because I want my average buy price to be lower. When the market is down, again, think of it like a sale. Stocks are on sale, so that's when you should buy. Then when it goes up, buy less or don't buy at all. Wait for it to go down again. Now, because in the long run, equities are expected to rise, you will have to adjust your buy levels higher when you notice that they are no longer being hit. I recommend that you read up on technical analysis so that you can be more accurate in setting buy levels. Maybe I will make an episode on that in the future, but for now, there are many resources available online that you can check to learn more about how to do charting for stocks and other assets. You can start with doing some research on support and resistance levels. So, my long term investment strategy can actually be summarized in 3 words: plan, park, shop. First, I plan. I set financial goals so that I know how much I need to invest regularly. I identify markets I want to invest in and set buy levels. Second, I park. I set aside a fixed amount every month for investing. This money is parked in a high interest savings account. Third, I shop. I buy when the market dips and hits buy levels. I avoid buying or reduce my buy amount when the market is booming. I do not sell because my time horizon is long term. Then I repeat the cycle. I plan again. I review the market to see if buy levels should be adjusted based on technical indicators. In the long run, buy levels may need to be adjusted upwards for markets that are performing well. It's important that if you want to try this method, you make sure that you have an account where you can temporarily park your money for investment in case the market is currently higher than your buy levels. In this way, you can be sure that you will invest that money and not end up spending it. Also, remember, especially when you are holding investments for the long term, you absolutely need to diversify to mitigate risk. Don't put all your eggs in one basket. The link to my video where I talk more about diversification is in the description. So I hope this helped you guys learn a bit more about how I approach long-term investing. Please like this episode and subscribe to The Money School. Thanks for tuning in. Bye!